Hello and welcome to Money Maximized. Today we are going to talk about significance of prospect theory. Prospect theory is a behavioral economics theory developed by Daniel Kahneman and Amos Tversky in 1979. It describes how people make decisions involving risk and uncertainty and seeks to explain why individuals often deviate from rational decision-making, as assumed by classical economics. Prospect theory has had a significant impact on our understanding of human decision-making in various fields, including economics, psychology, and finance. Here are the key concepts and components of prospect theory. Value function. Prospect theory posits that individuals evaluate outcomes in terms of gains and losses relative to a reference point, rather than in absolute terms. The value function represents this evaluation and is typically depicted as an S-shaped curve. It shows that individuals are more sensitive to changes in outcomes when they are in the domain of losses, the left side of the curve, than when they are in the domain of gains, the right side of the curve. This means that people tend to be risk-averse when it comes to gains but risk-seeking when it comes to losses. Reference point. The reference point is a critical element in prospect theory. It serves as a baseline against which individuals assess outcomes. Depending on the context, the reference point can vary. For example, when considering a financial investment, the reference point may be the initial investment amount. Loss aversion. One of the most important insights from prospect theory is the concept of loss aversion. People tend to dislike losses more than they like equivalent gains. This leads to risk-averse behavior in situations where they face potential losses. Diminishing sensitivity. Prospect theory also suggests that people exhibit diminishing sensitivity to changes in outcomes as the magnitude of the outcomes increases. In other words, the difference in emotional impact between a small gain and a slightly larger gain is greater than the difference between a large gain and a slightly larger large gain. Probability, weighting. People often deviate from expected utility theory by not accurately assessing probabilities. Prospect theory suggests that individuals overweight small probabilities and underweight large probabilities. This means that they tend to overreact to low probability events and underreact to high probability events. Decision weights. Decision weights represent the subjective probabilities that individuals assign to various outcomes. These weights are not always consistent with objective probabilities. As prospect theory suggests, people tend to overweight small probabilities and underweight large probabilities. Prospect theory has been used to explain a wide range of phenomena, including gambling behavior, investment choices, and consumer decision-making. It has also been influential in the field of behavioral finance, where it helps explain why investors might sell winning stocks too early and hold on to losing investments for too long. Overall, prospect theory has provided valuable insights into understanding how people make decisions under risk and uncertainty, and has challenged the traditional economic assumption of rational decision-making. Thanks for watching, and don't forget to like, share, and subscribe.